Okay, let's go.
So today, we're going to break down a trading strategy that our source claims is, well, maybe the only one you'll ever need. It's a super simple, rules-based, three-step formula that's designed to cut through all the noise. So let's dive in and see if this thing actually holds up. Okay, now that is a bold claim, right? This isn't just some random idea cooked up overnight. According to the source, this thing has been back-tested thousands of times. And the results? Consistently profitable over the long haul. Honestly, that's the hook that got my attention. So let's see what's really under the hood here. So, what is this magic formula? Well, the whole idea here is simplicity. You're not going to see a bunch of complicated indicators cluttering up your screen, and you don't need to memorize 100 different chart patterns. Nope. This focuses on one thing and one thing only, what the price itself is actually doing. All right, step one. This is maybe the most important piece of the entire puzzle. It's all about understanding market structure. Now, I know what you're thinking. I already know how to spot a trend. But here's the kicker. Our source argues that most traders, they get this part completely wrong. And fixing this one mistake is the key to everything else.
I mean, we all learned this on day one, didn't we? An uptrend is just a series of higher highs and higher lows. It's like trading 101. But believe it or not, according to this strategy, this very basic definition is actually where all the confusion begins.
So here's the challenge for you. What if that simple definition has been leading you down the wrong path this whole time? What if the way you've been taught to spot a trend reversal is based on a really common but really critical misunderstanding?
And this right here, this is that exact mistake in action. You see the chart, it's in a nice uptrend, making higher highs and lows, and then it pulls back, and bam, it breaks a recent low. What do most people do? They think, oh, the trend is over, time to sell. According to this strategy, that assumption could be a huge, costly mistake.
Now, this is where the light bulb really goes on. This strategy makes a huge distinction between an invalid low and a valid low. See, an invalid low is just market noise. It's a little dip that doesn't have the strength to push price to a new high. But a valid low, that's the real deal. That's the pullback that leads to a new peak, and that's the only one that truly matters for confirming the trend.
So if you remember one thing from this step, make it this rule right here. For a low to be considered a key part of the structure, a valid low, the move that comes after it has to be strong enough to break the previous high. If it doesn't, then that low is basically irrelevant. You just ignore it.
Okay, pop quiz. Let's say the price has been moving up. It pulls back, breaks some minor recent lows, but it hasn't touched the valid low that created that last big high. So, what's the verdict? Are we in an uptrend or a downtrend?
The answer? We are still, without a doubt, in an uptrend. And why? Because that little low that got broken, it was an invalid low. It was just noise. The main trend is only officially in trouble if the price breaks below that one valid low that kicked off the last new high. As long as that level holds, you're still looking for buy.
All right, so you've mastered step one. You know how to spot the real trend. Now what? How do we actually find a spot to get into a trade? Well, that brings us right to step two. Supply and demand zones. And this builds directly on what we just learned.
And the idea here is super straightforward. If we're in a valid uptrend, we're hunting for demand zones. That's where all the buyers are hanging out. If we're in a valid downtrend, we're looking for supply zones, where the sellers are in control. It's all about trading with the flow, not trying to fight it.
So how do we find these hotspots? Well, first, you confirm your valid uptrend. Then, you scan the chart for an area where the price just kind of goes sideways for a bit. That's consolidation. What you're waiting for is a big, powerful, explosive move up and out of that consolidation. The demand zone itself? It's the last down candle right before that massive upward launch. That candle represents the last gasp of the sellers before the buyers took total control. Now for the third and final step. We've got our trend, we've got our entry zone. This last part is like the quality control check. It's the filter that separates the OK trades from the A+ trades. And according to the source, this is what can seriously boost your profitability.
And the magic number is right here, 2.5 to 1. This is your absolute minimum risk to reward ratio. Think about it. By only taking trades where you stand to make at least 2.5 times what you're risking, you can be wrong more often than you're right and still come out profitable in the long run. It's a mathematical edge.
Let's put that in real money terms. If you're risking $100 on a trade, your profit target must be at least $250. And this isn't a suggestion.
It's a hard and fast rule. If the math comes out to 2.4 to 1, you walk away. No exceptions. No matter how good the setup looks, if it doesn't pass this filter, it's a no-go.
So we have all the parts. Step 1, the valid trend. Step 2, the demand zone. Step 3, the 2.5 rule. Now let's put it all together and see what a perfect trade looks like from start to finish.
Okay, let's walk through it. First, we confirm we're in a valid uptrend. Check. Second, we find that sideways consolidation and we mark our demand zone. Got it. Third, and this is the hard part, we have to be patient and wait for the price to pull back to our zone. Fourth, and you do this before you enter, you do the math. Your stop loss goes just below the zone and your take profit target is the most recent high. Does that give you at least a 2.5 to 1 ratio? If the answer is yes, and only if the answer is yes, then you enter the trade.
And there you have it, the entire strategy in a nutshell. A really clear, rules-based system. Redefine the trend, pinpoint your zone, and apply a strict risk filter. The source really presents this as a complete formula, which kind of leaves us with this big question, doesn't it? Can the wild complexity of the financial markets truly be navigated with such a simple, disciplined approach?